We're going to take a look now at the other question in that exam, and that's question 4, which I'm calling Handford. Mixture of discussion and some knowledge of something around pensions, though the numbers look a bit of a mystery at first. Starts out quite comfortably with 4 marks on the IFRS for small and medium entities. So this bit, if you've learned the basics that are in our notes, should not cause any problem. A1, it's only 4 marks anyway. But first of all, we're asked to explain the nature of IFRS for SMEs, and then also within that 4 marks, what are the principal differences from full standards. In terms of the IFRS for small and medium entities, the thing that we're all familiar with is that if you are a small or medium-sized entity and you want to, you can apply this, and it's a single standard as opposed to a set of standards. So the message is that this, if you choose to apply it, is a single self-contained standard. In terms of differences, candidates would have memorised a list of half a dozen, so I don't think that would cause any great problem whatsoever, unless they'd just not learned the IFRS for SMEs. But you could, for example, say that there are, for example, differences are that there are, understandably, no rules in respect of standards that only apply to listed companies. So there's no requirement, for example, for EPS, IAS 33. There's no requirement for separation of the business into segments or segmental reporting. So I think, pointing out the differences wouldn't be a problem. You could point out some of the simplifications. For example, goodwill. Again, you can only use the proportionate method of calculation. So we should be able to pick up full marks on that without too much trouble. I would have thought anyway. The second part, again, the requirement sounded very, very confusing because it asked us about information asymmetry. I'm not even sure how to pronounce it. So clearly you would have been scratching your head and saying, I don't know what that is. The point is, it tells you in the scenario. So although it's towards the end, which I thought was a little bit dirty, it does say down there, information asymmetry means that people have got access, there's 2 M's I think in asymmetry, people have got access to different levels of knowledge. So the company knows a lot about what it's doing, the investors don't know very much. And of course, I suppose with the IFRS for SMEs, investors know even less because there are so many exemptions from full reporting. So any kind of points in terms of discussion there, it's only 4 marks. I think once you'd realise that, you'd be able to get at least a couple of those marks. But, it's all around the theme, isn't it, that the investors need information. The more information you have, the more information that the more likely you are to invest. So, for example, lack of information would therefore mean at the end of the day that you're less likely to invest. And of course, that would presumably again mean that things like risk would go up. So investor risk goes up. And the expected return would go up as well. So I think we should be able to have a little bit of a rant about that whilst referring to the SME standard. The third requirement was then to say, what about the impact of integrated reporting, which, as you know, is one of the ACCA's great favourites, though it might not be yours. How would integrating reporting again help, again, the SME to understand and communicate the way in which it creates value? So this again was 5 marks, but we would get some basic points out, wouldn't we, by saying integrated reporting is synonymous with value creation. It's synonymous with the 6 capitals, but some of those that you could perhaps discuss in particular are the fact that there is intellectual capital, which is not normally in the accounts, that intellectual expertise, human capital. If you're working at the moment, your employer does not show you in the financial statements, unless you're a professional football player, that is. So giving all this extra information would therefore help the business to understand itself, would help investors to understand the business as well. So again, I mean, another word that you can talk about, isn't it, is that integrated reporting is always all about forward-looking information. So effectively, all good stuff. You could talk about the impact in the current world, the fact that as businesses become increasingly e-businesses, then there's going to be more and more of this intellectual and human capital that simply isn't in a traditional balance sheet, which was set up to deal with someone that does manufacturing or straightforward retail. So, I think you could have an argument there about how this would assist the SME in understanding itself. It would also, again, assist, the investors, in understanding the business. So there are plenty of points in there that I think that we could make in terms of impact of integrated reporting. In that discursive part of the question, there were 2 style marks as well. And again, remember that you'll get one of those as a minimum if all you simply do is make sure you've got some decent subheadings in when you have your little bits of argument. These are the sorts of little bits of questions. They don't tend to repeat themselves very much. But using the points I've made, again, plus perhaps the characteristics of financial information, faithful representation, relevance and comparability and so on, we could probably have a reasonable argument. The second part of the question, part B, was really absolutely quite different. And in the second part, we had this issue of this additional employee benefit. If you need to, just pause the tape or pause the recording for a moment, have a read of it again, and let's just try and think what on earth is going on here. It's an example of something where if you plunge straight into the printed answer, you will emerge more confused than at the start. So let's go back to basics. The first thing is, when you read the scenario, it sounds a bit like a pension because it's got words in like service cost, interest cost, actuarial difference, which is another word for remeasurement difference. So it sounds like a pension. And then you're thinking, I suspect, you're saying, well, I wonder if this is share-based pay because it's something where the employees have to stay for 5 years. Well, it's not share-based pay because you're not giving them shares and you're not giving them cash that's linked to the share price. So share-based pay is out of the window. Is it a pension? Well, it looks like a pension. What's odd is there's no separate pension fund. The money is paid specifically by the company. So the company actually, is responsible for making sure it's got enough assets of its own, but there's no contributions in here or anything like that. So it is like a pension. In fact, it's what would be regarded by the pension standard as another long-term benefit because it doesn't run up to a retirement age. Other long-term benefits are dealt with in the same way as pensions. You still get the service cost and the interest cost in the P&L. The only difference is that remeasurement differences go in OCI. Who would have known that in the exam? Almost no one. So the examiner was clearly saying in their commentary that if you didn't happen to know that and you thought it went in OCI, so be it. You're not losing loads and loads of credit there. But what we could do is stumble around, because you are stumbling a bit on this, aren't you? And you're saying, well, in a panic, what could I say? As opposed to getting the question exactly right. So let's look at these requirements. First of all, how should it account for the current service cost? So clearly, you start, don't you, by typing in the fact that there must be some kind of service cost in the profit and loss. Given the numbers, it's begging to be worked out, isn't it? Therefore, we would probably do some kind of calculation of that, even if we're not quite sure exactly how it would be processed. So we would do some kind of calculation, just using the numbers and letting them lead us through. So I suspect you'd do a calculation that looked a bit like this, because it says that the bonus is linked to the expected final salary. So let's work out the expected final salary. Well, the expected final salary, 1,100, but you need to go forward effectively 4 years. So 1,100 times 1 point, I think the rate was 3%. Let's just look back at that scenario for a moment. Yes, 3% increased by 3% each year times 1.03 to the power of 4. So the expected final salary looks like, in round sum, 1,238. The benefit is only 1% of that. The numbers look like they're going to be very small. So that therefore means 12 or 12.4. There's only a 75% chance of having to pay out. 75% of 12.4 is 9.3. That needs to be discounted to present value. So this time I'm using the discount rate. So times 1 over 1.05 again to the power of 4. And that's coming out as, I think, 7.7 or 7,700. Then I'm sure you'd be scratching your head and saying, I don't know what to say now. So some people, I think, would go down the route of saying, well, perhaps that's spread over 5 years. I understand your logic. I would give some credit for your thought process. Technically what happens, but this probably won't come up for another 30 years, is the 7,700 would be expensed immediately, and then at the time when they commit themselves to this payment, and then the difference between the 7,700 and the 9,300 would accrue over the next 4 years. So I think that's what they will have done in the answer. So it's almost as if there's an assumption there that the future service does not actually, again, accrue benefit. But let's not get too worried about it. The message is that either way, the 7,700, again, will be reflected in the profit and loss as service cost, and that over the next 4 years, the discount will unwind, the liability will get bigger, and as a result of that, again, there'll be an additional charge in the P&L. The comments of the examiner seem to indicate that people couldn't really get their head around it. I'm not surprised. All we can do is survive, isn't it? Part A of the question was fine. It was fine. In B, we'd get something by saying, well, I can have a stab at the calculation. I think it looks a bit like a pension. And that would be fine. Again, you're competing with lots of other people. The important thing is that you have timed yourself properly, so you've given yourself 40 minutes or so to have a go at this question. Technically 45 minutes, of course, but everyone gets a bit behind, and that you've put down some basic points. And then strangely, for the last couple of marks, they then ask us what would happen if the employee salaries increase above 3%. Well, understandably, that's going to increase the profit and loss charge. We don't need to do a calculation. So that will increase the charge in the profit and loss. What would happen as well if the probability of leavers decreases? Well, again, that would also increase the charge, because if the probability of leavers decreases, maybe if only 20% are leaving, we should have multiplied by 80% earlier on. So these are changes in accounting estimate. This would again increase the charge in the profit and loss. As always in this exam, you start off like a bouncing bunny rabbit as you enthusiastically go into question 1, and then you feel like you've been in the ring with Mike Tyson by the time you limp to the end of question 4. Everyone's in the same boat. My job is to help you to try and find some easy marks. So don't decide now to spend 4 months investigating other long-term benefits, unless I say you're planning to do the exam in 2059, when perhaps this rather odd one comes up. But it's all about keeping the basic approach, trying to get the basic knowledge down. We'll never get everything right. It's not intended. No one ever has. No one ever will, except, of course, the examiner. Thank you so much for taking the time to listen to the debrief, which I hope you found useful. Thank you.